Good evening, everyone. It's my pleasure to welcome Ms. Devina Mehra, Mr. Achin Agarwal, Mr. Naveen Karmat, and everyone else for the First Global team. First Global's Indian PMS IS Super 50 has completed 2 years, and during this time horizon, it's the top performing multi-cap PMS in India. My heartiest congratulations to all of you and the entire team for that. Now, the entire audience is well versed with our speakers, but for those of us who are new, let me just start with a quick introduction. Ms. Devina Mehra is the founder, chairperson, and managing director of the First Global Group. She is an IIM Gold Medalist and has been awarded many accolades throughout her academic life. She started her career with Citibank, leaving in 1993 to found First Global. She also heads the research and fund management at First Global, a cell in charge of identifying key changes and inflection points in markets across the world for global clients. He's called out major market turning points time and again and was an early investor in names like HDFC Bank, Amazon, Apple, etc. She's been widely quoted in Wall Street Journal, Financial Times, and other leading national and international publications. She's a frequent face on TV on all the top business channels. Thank you, ma'am, for taking out the time to be with us today. Mr. Achin Agarwal heads the Quantitative Research, Artificial Intelligence and Machine Learning Unit at First Global, leading a team of highly qualified mathematicians and engineers. He has been extensively involved in research in various fields of mathematics and AI, including deep learning, NLP, genetic algorithms, etc., and their applications in asset management and investing. He has built scalable quantitative models that invest across a wide range of asset classes across multiple geographies and has successfully managed global funds for over a decade. He has an MBA from IIM Bangalore, where he was featured in the director's merit list, and a B.Tech in Computer Science and Engineering from IIT Kharagpur. Thanks, Achin, for taking out the time to be with us today. So just to give you an idea, this webinar, the main audience is SMFS clients who are existing FG investors, as well as those who are looking to add PMS to their portfolios. For the audience, we're going to cover this in the next 1 hour. We're going to cover some PMS basics, what a PMS is, why it should deserve a role in your portfolio, focusing on the strategy of First Global IS Super 50 and the investment philosophy and mantras of First Global. We are doing a quick presentation followed by a Q&A.
Hi, and thank you, Shrey, for a very kind introduction. So as you mentioned, I'm happy to talk to all of you, talking a bit about PMS as a product itself, because as Shrey was saying, that some people are not so very clear about what a PMS is. And then about what we do differently in our PMS, because as Shrey mentioned, our PMS has not only been the top performer on a return basis, but on a risk-return basis, risk-adjusted return basis. And what time better than now to see what actually a risk-controlled PMS looks like and how it performs in a turbulent market, like for instance, yesterday's market. So we have a slide on that also, that how we handle that. So let me start off by why you should consider PMS as a part of your investment portfolio. And there are a few reasons to why it makes sense. First of all, of course, you must understand that the PMS is a structure, just as the mutual fund is a structure. So what matters more than the structure is the fund management, the fund manager, and the investment strategy or the investment philosophy behind it. Whoever is doing the admin, can you switch this bell ringing every time anyone comes in, because this is very distracting. So please switch it. Yeah. Okay. So this is the first thing that really you have to go behind rather than say that I will buy a mutual fund or a PMS. You have to understand what that mutual fund is or what that PMS is all about. And the basic difference in a PMS versus a mutual fund is that in the case of a mutual fund, you hold the fund units and the fund holds the shares. Here, the shares or the stocks or the securities may not be shares. It may be things other than equity, depending on what kind of scheme you are invested in. They are all held directly in your name, in your demat account. It is not pooled with other investors. It is just that you are allowing For example, if First Global is your PMS provider, then you're allowing First Global to decide what you should hold in your account, but it is still held directly in your account. The second point is that there is 100%.
Thank you. Same for you.
Sorry, did somebody say anything?
Admin, can we mute all the mics during the presentation and we'll bring it up during Q&A?
Yeah, it will be done in short. It will be done in a moment. Ma'am, you can please proceed. I'll just inform the team to mute all the participants. Ma'am, you're on mute mode.
Somebody must have muted me. Okay. So, can you switch off this as well? This one enters. Please ask whoever is doing the admin to switch this off. Okay, so the second point arises of the first one, because it is held in your account, there is 100% transparency. You can see all, not just see your holdings, you can see all the transactions in your portfolio on a day-to-day basis, because you have a direct login into your account. Then, compared to a mutual fund, a PMS has far more flexibility. So, PMS actually has, for example, in terms of how much cash you hold or what you hold in various market caps, you can decide how you want to do that within a PMS scheme. For example, some time back we had over 20% cash because markets were extremely volatile, but that is not something a mutual fund always has the flexibility to do. In a PMS, again, you can choose which asset classes you want to be in if you're looking at things beyond equity. And then, of course, the portfolio can also be customized to your needs. I mean, normally we go with the same kind of portfolio for everyone, but we do have customers who have sensitivities, for example, who do not want to buy alcohol companies or, for example, companies where animal products are processed, like meat products or leather or something. So you can put in those kind of, which is not possible in a mutual fund. And then I think the point that is very, very important, that you have somebody answerable, somebody accountable. So like, if we have a PMS customer, they can interact with the fund management team. They can ask questions on email. On occasion, we will be addressing webinars like that, or sometimes for larger clients, it may be a one-on-one also. Whereas mutual funds are faceless entities, no matter what is happening in terms of performance, good, bad, ugly, you don't have anybody you can hold accountable. So this was a general template of what is possible within a PMS. But the more important reason is that we must, a more important thing which we need to focus on is that the way we do PMS or a portfolio management scheme, which is very different from the way most of the industry runs. So as I said right at the beginning, the important thing is not the structure, the important thing is the way things are being done. So now what we find is that an artificial intelligence and machine learning driven quantitative investment is disrupting the investment landscape. And if you do not move along with these changes, you would be rendered obsolete. And you cannot afford to be rendered obsolete. And this changing landscape, I mean, I will give you an analogy which makes it clear. I mean, we often talk of changing of the playing field, but there have been cases where literally the playing field has changed, like hockey moved from grass to AstroTurf. When it was played on grass, it was an uneven surface. Then it mattered how well you dribbled, your stick work and all of that. AstroTurf made it even surface, and a different set of skills became important. How fast you can run, how fit you are and so on. And why, if you did not transform yourself in time, you were rendered obsolete, and which is what happened to India and in fact the whole subcontinent. Dominated hockey till the AstroTurf came in. So now from 1930s to 1970s, you dominated hockey, and then you were out because you did not change your skill set. Tennis similarly moved from wood to titanium rackets with many, intermediate stops, and you could not play with yesterday's instruments. And came back with his wooden racket, and he could not make a comeback because the technology had moved on. Today, and car maker cannot say, I will stick to combustion engine and not look at electric vehicles. They'll be left far behind. And something similar is happening in the fund management business, whereas most of the industry, whether it is PMS or mutual fund, is still stuck in the 90s, or if not prior to that. And why is this changing? Why is the landscape changing here? Because earlier the edge of the fund manager used to be to get privileged information. I mean, not necessarily as insider information, but you could meet a company, you could visit their plant and get some information which was not available to everyone. And I have done a lot of that. I have seen countless plant, steel, aluminum, auto components, all of that gone to the dusty outskirts of the NCR, Hyderabad, Madras, you name it, and pretty remote areas in Andhra, and even a place like Renukut, which is in the middle of nowhere in UP. So I've done all of that, but that was then. And internationally also, it was the same. A Fidelity could sit in a closed room with a Procter & Gamble or Walmart or IBM and get some information. But now that has been regulated away. So now what is the skill set that is required? Because now you as a retail investor also can go and see a con call transcript, even if you can't attend the con call directly or when the quarterly results come out. So now the skill set that is required is managing and analyzing large volumes of data instead of looking for information and data. And that is where you need the human plus machine model, which is what we talk about. So why human plus machine? This is a very interesting nugget before I go into the details of that. Many of us had heard of this IBM Deep Blue computer, which in the 90s beat the world chess champion, Garry Kasparov. But not many have heard of the sequel to that, which was that there was a 2005 tournament where there was a team of human chess players who were good chess players, but they were not world champions, and who were supported not by any fancy machines, but by laptops. But that good enough human with a good enough machine could beat the best computer in the business, which in turn had beaten the world chess champion. So this is how human plus machine does better than both human only and machine only. And the reason number one for that is that machines can analyze a very large number of securities. Globally, we analyze over 20,000 securities. In India, we analyze something like 800 or so securities which meet our liquidity norms and come up with a list out of that. Now, that is not possible for a human being to do or a team of human beings to do. The other thing is not just the number of securities. We look at hundreds of refined factors for each stocks, like, for example, not just growth, but the first derivative of growth, second derivative of growth. So in a sense, looking not just at velocity, but acceleration and jerk. And sometimes the signals come first in the higher derivatives. And you can combine a very, very large number of factors. Then the machine is consistent. Let us say, I had to analyze 20,000 securities. Yes, I can have 1,000 analysts looking at 20 companies each, but each of those 1,000 analysts will look at the same numbers, the same facts differently. A machine is consistent. Reason number 4, very, very important, a machine is bias-free. All us human beings are products of our biases. I have written about it often. I have made videos about it, and you can read whole books about it, like Thinking Fast and Slow, the Halo Effect. the invisible gorilla, and so on. And I will not go into the details of this because that's a class, if not a module in itself. But there are many biases. For example, you will see a lot of fund managers waxing eloquent about their holdings, about the stories of their holdings, that why they are great, why the management is great, why the business is great, because human beings love stories, but the market doesn't care about stories. I mean, for example, you hear this story of that if you buy great consumer brands which generate cash, you can never go wrong and you will always make money. But you look at the data, all those companies, for example, the FMCG companies, each of them individually have had between 7 to 15 years of huge underperformance, and many times underperformance on the fundamentals also. If you look at this year itself, the market, I've not seen the data as of today, but 2-3 days back, I was looking at the data, and the FMCG index was among the worst performing indices for the year, in spite of being an underperformer last year itself. So always there are myths built around things because human beings like stories, human beings, the bandwagon effect, because human beings like to be in a group, they want to be part of a group rather than be solitary. So, I mean, there are a whole lot of biases, and no matter how well you understand them, you cannot get them out of your decision making because they were important to you once upon a time when you were in the jungle, you were trying to get away from a saber-toothed tiger as a human being. All these biases helped you, but in investing, they don't help you. So the machine is bias-free. And reason number 5 is that as human beings, we all decline with age, but machines improve. And one of the reasons is that the machine has no problem saying that I was wrong, that I made a mistake. And hence it goes back, it learns, it analyzes. Whereas as a human being, we have this huge mental barrier in admitting a mistake, which again was helpful to us once upon a time. But in investing, that's a big negative. So but now the thing is that, so are the machines the answer to everything you can think of? No, we think human beings also have a role, and a very important role. And that really comes at, okay, before coming to that, let me just quickly give you an overview of what are the, I mean, I will not go into the details, but this is the first global investment tech stack, which is the different models that we use. For example, in Turbo, we evaluate these 20,000 plus securities on hundreds of parameters. We have a weight watcher where we look at how different asset classes, the weights change over time. So commodities may underperform for 15 years, but at some point they will start to outperform. So you watch out for that. Glocom, you look at how things move across the world, and many times you will find that industries move together across the world, and not just in obvious things. Like, for example, you know that in metals, the dollar price is a big determinant. So it is likely that aluminum producers around the world will move together, but it will, even in purely domestic markets, many times you will find that the patterns persist across markets. So there are things like that, many things that we watch, or rather our systems watch for us. And coming back to what I was saying, that human beings are still needed at 2 stages. The first stage is that you have to code the machine correctly. And this is why, I mean, 2 things I would like to say. Many people think or say that we use quant methods. And I always say that's like saying that I use an Excel file. So you and I and 15 other people may know how to use Excel, but are we going to make the same financial models? No, we are not. It's all going to be different. And in quant in particular, it depends on how much detail you go into, how much rigor you go into. And trust me, we have done it through a very, very rigorous process. So we've had people who were from technology, tech entrepreneurs who have invested with us, who said, take us through the detailed process as to how you did it, and why do you say you have millions of lines of code, where have you used it? And at the end of it, they said, this is something that we have not seen even elsewhere in the world, let alone in India. So, but as I said, human beings are critical. You just can't have reams of computing power and have that as being good enough. So you have to have human beings who had expertise in the market, who had experience in the markets. So you are sure that the factors that you are using are logical, and there are no spurious correlations. And in the world, there are many spurious correlations. If you plot nuclear energy against cheese consumption, the correlation is 1, or people drowned against something which is totally random, it will again be 1. So we have to make, and this is really the problem why a quant only system often goes awry, because people just analyze a lot of data, and if you analyze a lot of data, something or the other will appear correlated, but that may not make any sense. So you have to start with sensible factors and then test them out, rather than the other way around. And the other stage where human beings are overlays needed is when things are not captured by pure data. I mean, the COVID crash being a very good example, that obviously in the beginning of February 2020, you did not know, I mean, it was not apparent from financials anywhere that of companies that there was this big trouble coming, but you could see things around the world. I remember in February, I had tweeted that later on, all these things became commonplace, but at that time, for the first time, schools had shut down in Japan and in Italy, and there were these pictures of all the Roman tourist attractions absolutely empty of people, and you said that this has never happened even during the World War, so something strange is going on, and which really informed our investment decisions of taking insurance, of moving out of equities in multi-asset portfolios, which is why we largely sidestepped the COVID crash. I mean, not that we did not go down, but we went down far, far, far less than everybody else. The other thing I spoke about, fund management being stuck in the 90s or 80s or 70s. And the reason for that is that most old school fund managers make a virtue out of saying that we invest only in our circle of competence. And I say it's a euphemism for a comfort zone. And why should you as an investor be a prisoner of your fund manager's comfort zone, that if she or he is comfortable, for example, only buying banks and consumer brands, if the market is at a phase when those things don't make sense, and maybe it is metals and cement that are looking good, why should you be constrained by that? And also it means that your risk becomes very high, because if you understand only 2 or 3 industries, even if you invest in 15, 20 stocks in 2 or 3 industries, effectively you are taking only 2 or 3 bets, because all of those will move together. So they become highly correlated and therefore highly risky. I will just hand it over to Achin to walk you through some of our risk management practices and our performance.
Thank you so much, Devina. So I'll start off with risk management, which is a key pillar of our entire investment process. So we are driven by something that Charles Ellis had once famously said. He said that investing is a loser's game. Okay. So what that means is that the key to winning is to avoid the big mistakes, avoid the big losses. And if you can do just that, you're already way ahead of everyone else, right? And that is exactly what we have done consistently over time. We did that in March 2020, when the markets were down 30, 35, 40%, and our funds were down, guess what, less than 10%. Okay, there was no other PMS, no other mutual fund in the country which had that sort of performance during the COVID crash. And it's not just a one-off example. I'll give you an example from something as recent as yesterday. We'll come to that in just a moment. But the point is this, it's all about staying alive during difficult times to fight another day. A number one mantra to investment management is avoid the big losses, avoid the big falls, and then you participate in the upside through an intelligently created portfolio. To the extent that we almost obsess over risk management, risk practices are embedded within every single step of the investment process. starting from the definition of the investment universe, where like Devina mentioned, we look at only the most liquid ends of the market, position sizing, having stop losses for each one of our positions, having a very, very advanced portfolio construction methodology. And another significant risk measure that we adopt in our portfolios, it's our proprietary model. We call it the tactical insurance for portfolio protection, TIP for short, where what we do is we purchase insurance for the riskiest parts of the portfolio. So it's a dynamic hedge that protects the portfolio in the turbulent times. Just like, you know, we buy health insurance, we buy life insurance and whatnot. So this is insurance for your investment portfolio, which is obviously one of the most important assets in anyone's life that needs protection. So,
Achin spoke about different market caps. So let me just give you a perspective on that. For example, our small cap exposure, even when we like small caps, is typically only around 10%. At the most, maybe it will go up to 13, 14%, nothing more than that. Because we think, you know, when things go south, it's very difficult to get out of those positions. So we always say in our PMS, you are paying 60% of the fees for risk management and only 40% for return management. Yes, Achin, back to you.
Yeah, and to add to that, so Devina mentioned the human plus machine combination in our investment processes, right? But when it comes to risk management, we don't rely on humans as much. Like, in fact, our risk management measures are exclusively driven by the machines, because humans are not good at taking losses. No, prospect theory has taught us that humans find it difficult to book losses, which then end up escalating into a completely different order of magnitude altogether. So the machines run the risk management measures. Where humans do step in is if through experience. So for example, Devina has lived through many, many different kinds of market cycles, and she's seen many, many crises from very close quarters. So when the team of humans does come in, that is only to make the risk measures tighter, never more relaxed. Okay. You know, this is data from yesterday. I'm sure all of you were glued to the news feed, and tough day for markets in general. And obviously, the geopolitical scenario is not looking pretty. But if we restrict ourselves to the narrow focus of what the Nifty 500 did yesterday, it was down by over 5%. But guess what? Our portfolios on average in the PMS had fallen less than 2%. In fact, only 1.6% on average. Okay. This is not something, like I mentioned, that, you know, that's happened by fluke or by chance, because this sort of inbuilt protection is something that is very, very inherent to our entire methodology of investment management. This is exactly how we had protected our portfolio during the COVID crash. This is how we've protected the portfolio in the current crisis. And this is something that will continue to deliver going forward also. So just a small, you know, demonstration of what we mean when we talk about risk management, because unfortunately in the industry, you know, everyone's just focused about return. Obviously, return is important. That's why you are in the game. But what's equally important, if not more important, is capital protection. How do you manage the risks? So that is something that we take very, very seriously. Moving on, what do the results look like? So Shreya had mentioned that we've just completed 2 years of our PMS, the India Super 50. Okay, so over the 2-year period, we have delivered a CAGR of almost 50%, whereas the benchmark Nifty 500 has been close to 30%. And it's not just the benchmark Nifty 500 that we've outperformed. We have outperformed every single multi-cap and large cap PMS scheme in the country. And then I have a separate comparison between our PMS versus the rest of the mutual funds also. So let's start off with the PMS universe first. So what you see here, the breakaway green line right at the top, that's us. Then there is a huge gap. And then you have all the rest of the players all clustered together. The period for this analysis is 1st of March 2020 up to the 31st of January 2022. Why? Because we went live in the last week of February 2020. For the peers, we have only monthly data. That is what gets reported with SEBI. So we've taken the first full month of our existence as a starting period and the data up till the last completed month. So we'll look at this data even more closely in the next slide. Okay, and this is a really important slide, and I'll be spending a few minutes here. So first and foremost, when you want to evaluate the performance of any portfolio, any scheme, you want to look at returns. Obviously, that's the most important criterion. So let's look at returns first. Okay, so as you can see, we have outperformed not just the benchmarks, but every other large cap, multi-cap PMS scheme in the country by a huge distance. Okay, nobody comes close to our 114% since our inception. The next best is below 75%. And even in calendar year 2021, nobody came remotely close to us. But that's just half the picture. Okay, returns are important, but what's even more important is what sort of risks are you taking to deliver those returns, which is where the rest of these measures are very important to evaluate and to understand. But before I talk about those measures, one thing that I'd additionally like to point out here is, unfortunately, so most of these names that you see here on this list have not even beaten the Nifty 500 in an absolute term. So, IIFL, Alchemy, Motilal, Marcellus, Axis, ASK, Ambit, they have not even matched Nifty 500 returns over the last 2 years. And then when you look at the risk adjusted returns, this difference becomes even far greater. So the column in red is basically the return divided by the volatility of returns. How smooth, how consistent, how stable have the returns been? Okay, so you take the return and you divide it by the monthly volatility of the return that the portfolio has delivered. You will see that we are not just slightly ahead of anyone else. I mean, the difference is huge. We are at 2.76. There is nobody at 2.5. Nobody even at 2. The next best is less than 1.75. In fact, most of the names that you see here are in the vicinity of 1 and below 1. Okay, that's your Sharpe ratio. And then another way to look at risk-adjusted return is to look at the gain-to-pain ratio, which is a very simple ratio, but very powerful. Okay, so it's the way gain-to-pain ratio is calculated is you take the net return that the portfolio has delivered in the numerator, and then you divide it by the sum of all the losses. Okay. Now, if so for example, if the portfolio has, out of the 23-month period that we are looking at, if the portfolio has lost money in, let's say, 8 or 9 months, you add up all the losses. That's your denominator. So what the gain to pain ratio is telling you is what is the net gain that the portfolio deliver for every unit of pain that the investor had to endure. Once again, we are at 4.4. There is nobody even half that value. Okay? And then the last two columns are showing how we've outperformed the Nifty 500 the maximum number of times. Okay, so the return has been most consistent. So high returns is great, but what's even greater is when those high returns are accompanied by a lower volatility, smaller drawdowns, and most consistent outperformance every single month. So that basically is the difference between luck and skill. Certain portfolios can deliver great returns just because if they end up being lucky for a period of time, but to be able to deliver high risk adjusted returns, that's a measure of true skill. And this is a performance with the rest of the large cap and multi-cap PMS schemes. And we've done a similar comparison with the largest large cap, multi cap, and flexi cap mutual funds also. So here, what you see is, all the major large cap, multi cap, and flexi cap mutual funds. Once again, there is nobody that even comes close to us. That green line still is significantly ahead of the entire peer group. Okay, and once again, not just in terms of returns, in terms of every risk adjusted return that you can imagine, the first Global India Super 50 has trumped every single mutual fund scheme also. And the key question here is why have we been able to deliver this kind of a return? And that comes from a rigorous process that Devina spoke about, and the dedication to pursuing that process, the richness of that methodology, of that human plus machine combination. And what that also means is that this performance, it's not as if that this was something that we were able to deliver by fluke. This is repeatable. This is exactly, obviously not in terms of the absolute returns, but in terms of the outperformance over what the broader market is doing. That is something that you can expect on an ongoing basis. So First Global obviously has been around for many years, over 3 decades now, and we've always been known for our groundbreaking research. So what you see here on the left is our research on Amazon way back in 2001, after the tech crash, when the world had written off Amazon. Business Week came out with a cover saying, "Can Amazon survive?" In that same week, First Global published a strong buy report on Amazon at $15. So First Global was the only firm in the world to have a buy, let alone a strong buy call on Amazon. And Jeff Bezos reached out to us and personally thanked us for the support at that time. We know what happened over the next 20 years. On the right, you see the cover of our report on HDFC Bank from 1996, 1 year after its IPO, at a split adjusted price of 3.8 rupees. So the cover shows a baby transforming into Arnold Schwarzenegger. That's how First Global saw HDFC Bank way back in 1996. And obviously, these are just a couple of examples. Like Sri mentioned, there have been, First Global has routinely been ahead of the market and has called out many significant pivotal turning points well ahead of when they occurred. And we've received accolades all around the globe. Alan Abelson, renowned journalist, when Alan Abelson says something, the world sits up and takes notice. He commended our research in his column in the Barron's. We've got in front page coverage on the Wall Street Journal. We got extensive coverage when our fund sidestepped the COVID crash last year. And we are known not only for our coverage on the US or the Indian stocks, but really for stocks from all around the world, including China, Japan, Europe, basically everywhere. We are a team of battle-hardened veterans like Devina, with her decades of hands-on experience and prowess in investing, not just in India, but really all around the world. And then, we have a team of battle-hungry youngsters like myself. So our team comprises fundamental analysts, data scientists, computer science engineers, all working towards one common objective: to refine our edge every single day. And there's a core investment team. Devina, like Shrey pointed out, is an industry stalwart with more than 30 years of investing experience. And she has, academic accolades all through her life. At Lucknow University, she won 8 gold medals, which is still date a record. And she was a gold medalist at IIM Ahmedabad also. I have the privilege of heading the Quant Research team. We also have Alok here on this call, who's been a pivotal part of the team for more than 17 years now. So some of the pieces that you saw on that Exotech slide, Alok build those pieces and continues to provide very insightful research using those. Kavita, once again, is also on this call. She's been with us for more than 20 years now. She heads fundamental research for us, and a lot of the global media coverage that you just saw, that all of that is Kavita's work. And of course, the team is much more than what you see here. We have some very, very talented and bright individuals in the fundamental and the quant teams put together, which is around 20 people large. And moving on to product, so we don't believe in a proliferation of products, so a lot of fund houses offer, mid cap, large cap, small cap portfolio separately, then they offer thematics and sectoral funds and whatnot. We don't believe in all of that. So our thinking is very, very simple. When someone comes to us, they are looking for a solution and not another set of questions to be answered. So within the PMS in India, we offer two products. One is the India Super 50, which is an equities only model where we invest in listed equities in India. Obviously, stocks which satisfy a certain market cap threshold and a certain liquidity threshold. And like Devina mentioned, across all market cap bands, that can vary, but obviously it's never heavily tilted towards small caps. Small caps will never be more than 10-15% of the portfolio. So that's the India Super 50 equities portfolio. And then the second product that we have within the PMS structure is the IMAP, which is the Indian multi-asset allocation portfolio. So the IMAP mimics the equities portion of the India Super 50, and then it has some fixed income, some commodities. Basically, it's a multi-asset, dynamic multi-asset product. So for someone who's not comfortable taking a full equity exposure, so it offers a slightly lower, a significantly lower volatility, but keeps the same high risk-adjusted return profile. Okay. So that is in terms of our products, and at the end of the day, you need to be in safe hands, right? You need to be with people who've done investing for a long time, people who understand the inner games, right? Just like one goes to an experienced doctor and an experienced lawyer. Similarly, it's very important to work with an experienced fund manager, because that experience in itself is very valuable. And when you marry that experience with the machine, what you have is a winning combination. And that is exactly what we have done. And that is the edge for you, because when you are with us, you are with the future, and your investments will be relevant from today for the rest of our lives. So that brings me to the end of this presentation. Over to Shrey. Shrey, would you like to start off with the Q&A session?
Sure. Thanks, Achin. Thanks, Devina, for a very comprehensive and insightful presentation. So let me just take a couple of questions that we got before the webinar, mostly from existing clients, and then maybe we can open the floor for clients in the audience members right now. So one question that we have, I'll just club a lot of questions actually. So investors who entered the fund about a year ago have seen about 40% returns. Investors who entered in September are seeing negative returns. That, of course, is a function of markets. But the question is, what should they be expecting this year?
So, I mean, yes, you're right that it is partly a function of the markets and also the fact that we are reasonably conservative. So, I mean, you've seen the markets fall, and especially certain sectoral indices fall. We think this year is not going to be as good as last year, definitely. But still, we do not see the risk of a huge crash. And the reason for that is that the Indian markets are not above their trend line. They're still far below their trend line. You really had only one very good year, which is 2021. Even 2020 from the COVID lows was a big move, but for the year as a whole was only a 14-15% move. If you look at India's position in the markets globally, for many years, you were number 19, 20, 21, 24, like that. Only last year, you reached number 6. So it's been only really 1 year of absolute performance and outperformance. So this year, we expect outperformance vis-a-vis the global markets, and we expect some absolute returns provided you choose carefully. I mean, this is going to be a choice of sector, choice of companies or stocks market. It is not going to be that everything goes up, that kind of market where many people who came into the markets just after that COVID lockdown think that markets go only up. That's obviously not the case. And in equity markets, if you're entering, you're looking at 4 months or 3 months or 6 months is too short a period. So you have to come with a longer perspective. And if you do that, if you're asking what you should do today, I would say that if you have money to invest, you should start in getting back into the market. So you should maybe not put everything all together at once, but over 2, 3, 4 months, you stagger it out. It's a reasonably good time to be entering the markets. Achin, anything you would like to add to that?
No, I think you've covered this quite well. I mean, given the fact that India has been coming out of a very, very long period of underperformance, so there's still significant headroom to grow. And just one point to add to what you mentioned, Shrey. So anyone who would have come in 6 months ago, exactly 6 months ago to this state, would have not been down 8 or 9%. They would have been flat to down about 1%. So I mean, just wanted to,
Exactly. Yeah, sure. Yeah. So next question is from Mr. Kanishk. He says, can you delve a little bit deeper into how much do AI and ML dictate the decisions? And if you can give an example of a decision that proved wrong in hindsight that was driven primarily by AI and ML.
So there, I mean, at a broad level, I'll hand this question also to Achin, but at a broad level, not 100% of our decisions will be right. Not 100% of any kind of fund manager, whether human machine combination, are going to be right. So this is a given. In fact, one of the videos that I made was for that every time you make a decision, you tell yourself explicitly that if I may be making a mistake, this may go wrong. Because the best you can hope for is that 70-75% of your decisions go right. You cannot even target that 100% of your decisions will go right, simply because this is not a deterministic world. It is a world of probabilities. At the beginning of 2020, who would have said that airline and hotel business will go to zero for 6 months or 9 months of the year? So you could not have made that. If after living through that, you do not realize that there is no 100% certainty of anything in life. So that's a given. So decisions, whether made by any system or us, some of them are going to be wrong. The way we do it usually is that the bulk of our portfolio is decided by a superset that comes out of a, let's say, through the system we get maybe 80 recommendations or 100 recommendations, and out of that then we will choose the 50 or 60 stocks that we will invest in using, when we say human also, it is not completely arbitrary or subjective. Most of it comes out of our other systems that we spoke about, like Agreement in Motion, Glowcom, Weight Watcher, which are also systems but which require some human interpretation. So that is how we do it. So it is not a black box. None of what we do is black box. So even when we say something a machine recommends, we always need to know as a human fund manager why the machine is recommending something, why the machine is not recommending or rejecting a stock. For example, the machine is very good at flagging manipulation. This might be strange to people, and as a human fund manager, it was a bit of a strange thing to me, because I thought that at least this one thing, as a human being, I'll be able to see. But if someone is fudging the numbers themselves, how will the machine catch that? But the machine looks at many factors and it manages to catch it, because you're looking at everything from how much auditor fees you are paying, how often are you changing your accounting policies, is there a big disconnect between cash flows and profits on an ongoing basis? And see, our system is not static. It is ever evolving. For example, one of the things which we are adding on now, which is to some extent we've added on, but to some extent it's still a work in progress, is analyzing non-financial or non-numerical data, looking at things like management reports or con call transcripts, and you'd be surprised at the kind of things that the machine can get out of that. For example, there is looking at something called complexity of communication, which essentially means that is your communication becoming more vague? So if over various quarters you see for the same company that their complexity is increasing, means they're somehow not confident or trying to hide something, that's the hypothesis. So, Achin, would you like to add to that?
Right. So basically the thing you have to understand is that it's not as if there's a human sitting making certain decisions and there's a machine sitting and making certain decisions and they're competing. That's not how it's structured. We call it human plus machine because all the decisions that go into the fund, into the portfolio construction, require inputs from both the machine as well as the humans. Right. And like Devina mentioned, one of the key things that we've done is we've increased the number of decisions that we can take. Because I'll give you some very, very broad math, right? So if let's say 75, let's say you're a very, very skilled fund manager or you have a very skilled machine and 75% of your decisions are correct, it's still probabilistic, like Devina mentioned. So if you're taking a grand total of 5 decisions, that does not mean that 75% of 5 decisions will always be correct. It could be that none of your decisions are correct or all your decisions are correct in a small sample set. But now instead of 5 decisions, if you're taking 100 decisions, 200 decisions, then you don't expect that deviation to be much, right? So if you're taking 100 decisions, you expect to be right 75 in 75 of them. What will happen? You'll be right 60, 65, 80, 85. So that operative range is closer to your expected value. And in terms of specifically about the machine, machine does a lot of different roles, like Devina was pointing out, identifying fraudulent activities or misreporting, manipulation. Another thing that machine does very well is combining different factors. So you can identify 20, 30, 40, 50, any n number of factors which are important to consider. No company or no stock will be great on all factors and terrible on all factors. It's going to be a mix, right? Which is where humans don't do very well. So for example, if I have great regard for the CEO of a company, I am very likely to overlook shortcomings elsewhere, and vice versa. So if I have this preconceived notion that the CEO is not straight, then even if the stock does well, if they're doing great things elsewhere, I'll still unnecessarily penalize that stock. So that objective combination of multiple factors to get the full picture is something that machine does well. And the second part of your question, can you give us an example where the machine went wrong? I mean, many. So like we said, 25% of the decisions that the human plus machine combo is taking will be wrong. So there's no dearth of examples there.
Sure. That's great. Naveen, can we open the floor to questions from the audience now? Since we're running a little short of time, I have a huge list of questions, but maybe we can give preference to any live questions that we get.
Right, please. We request audience to come forward and raise your query.
And while they're doing that, I'd just like to add one thing that we talked about. Shrey mentioned a comprehensive presentation. So this is not a comprehensive presentation in the sense this is only about our India product, but we have global products as well, which even as an Indian you should consider. But we'll do a presentation on that another time.
Definitely, ma'am. I'd like your time in the future to take a presentation on that also. Yeah.
So just.
Thank you, ma'am. Investor who want to raise a query, please raise your hand so that we can unmute yourself to put forward the query. Yeah, Komal.
Yeah, hi. So I have a question. You had mentioned that, the market since, September onwards, it has been quite volatile. So my question is that if you can segregate your portfolio into 2 parts, one is before September when the market was up and post September when the market went down. So now since the market went down, a lot of people would have invested that, invested money. And I understand that, of course, this market, has been going down since then. What are the, how are you mitigating those risks? Are you, individually looking into the portfolios of the people whose portfolio has gone down more than 1.65% that you had mentioned? Because I understand that individually, of course, the downside is more actually. So are you looking at individually or total portfolio that you guys hold? And how are you, thinking? I mean, what are your analysis to increase that? How are you mitigating the risk?
Okay, first of all, I mean, there is no great discrepancy between the portfolios because all the portfolios more or less move together. There might be minor, differences on a certain day, certain transaction didn't go through or something like that. But otherwise, the movement will be all together, right, Achin, Alok?
Yes, absolutely.
When you say all together, it would be same. I mean, I disagree because people who might have invested when the market had gone down and since then it has been going down because of a lot of economical factors. Do you look individually or in together only you look at the portfolio?
See, as I said, that all the portfolios have the same stocks in the same proportion, so they will move together. That minor, there might be that certain day one trade did not go through or something like that, but that will not cause any significant differences. So it is not as if that if you came on January 1, your 2021, your portfolio today will look different from somebody who came in September. No, I mean, everybody's portfolio is the same, except people who have these kind of customizations that no alcohol or whatever their, or only Sharia compliant stocks, whatever their would be. Otherwise, all general portfolios are all the same.
Okay. Any factors considering economy is going so much of volatility? Any other factors that you consider to ensure that return is positive? Even the market is like 5%, it has gone down, but still.
So that is what we try to do as much of risk control as possible. That is why, as Achin showed that in yesterday's market, which was down 5% on Nifty 500 and in fact down more on the small cap and mid cap indices, we were down only 1.6%. So, we try to mitigate that risk as far as possible in terms of the choice of sectors, in terms of all the risk control measures. But I mean, it is not that the general market conditions will have 0% impact on your portfolio.
Okay, thank you so much.
You're welcome, Kumar.
Mr. Mittal, yeah, please go ahead.
Hi, good evening. It was a very knowledgeable, knowledge-gaining presentation as such. My small query is this: do you do only equities or you do options as well?
No, it is only equities, and option is only to the extent of hedging. So we spoke about that tip that Achin spoke about, tactical insurance for portfolio protection. So that is done through derivatives, through the hedges. And in fact, the PMS guidelines also do not allow derivatives beyond their use as hedges.
I understand it. Thank you very much. Thank you.
My question was to do with the ML model that you guys create. When you're training the model, you'd mentioned that you look at technical data for companies. Do you also look at fundamental data like social media presence, blogs, news? And if so, what is the kind of weightage that you give to fundamental data versus technical data when you're training the model? I'm assuming this is supervised learning for your model.
So, I mean, when you say technical data, it is not technical data, it is fundamental data that we are primarily using, which is all the financials and other data for the company. So the primary data is the fundamental data, the bulk of the data, let me say. And of course, we do use the price data, etc. also, which you're saying the technical side. So, but if you're talking about unstructured data like social media or as I said, that things like con call transcripts, management reports, etc. We've started using it, but that's still work in process. So it's not that part is I can't say is 100% there in the model yet.
Right. So
unstructured data is much more complex to use.
Okay. So
Achin, would like to add?
Your weightage would be skewed towards what you're calling fundamental data. Your prices.
No, not what I am calling. That is what is called fundamental in any financial markets or in financial textbooks. That is fundamental data. That is what is called fundamental data.
Fair enough.
Yeah. So, but as if you're talking unstructured data, that is something we are working on. For example, HDFC Bank, while we've liked it a long time, now we don't think that's the best place to be in. And very interestingly, one interesting thing which we found in their con calls was that over the quarters, their con calls have been growing longer. The management part has been growing longer. Q&A has been becoming shorter. And the other interesting thing was that it has now less numbers, fewer numerals in their con calls and more words. So that was an interesting finding from there. Achin, anything you would like to add?
Right. So, like Devina mentioned, the core of what we use the data set is financial data, right? So the income statement, balance sheet, cash flow statements, all numbers from that, and obviously we look at price data also, and we are looking at con call transcripts. Another data set that we look at is governance data. Now, there's a lot of interesting data around that. So, for example, what is a key management compensation? How does it compare to the compensation of the rest of the organization? How much of the promoter holding is pledged? What is the composition of key committees? What sort of independent directors does the company have, and what sort of other companies are they on? So basically the entire directorship network. So lot of very rich data is available. And if you talk about our global products, which is not very relevant here in India, but a lot of very well structured analyst estimates are available, where you can look at dispersion of analyst estimates, what sort of revisions are being made, beats and misses. So some very, very rich data is available. And then what we do is we construct intelligent factors out of that. And once you have these different factors, the weightage to each factor is obviously coming from a supervised learning algorithm, right? And these weightages are not constant. And that is not to say that we use only supervised learning. There are certain parts of the process where we use unsupervised learning also. So for example, when you talk about industry-wise exposure, the typical way in which most people do it is by classifying each company into one particular industry. Now, how do you categorize a company like Reliance, right? It cannot be categorized in one industry, but that's what traditionally has been done. So what we do is we find the sensitivities for each company to various sectors. Okay, so each company will have sensitivities to multiple sectors, and then we look at our sectoral exposures overall, right? So that comes from an unsupervised clustering algorithm. So I mean, ML, like I mentioned earlier, it's not as if one set of decisions are being taken by the human, something else by machine. It's a fairly involved process, and there are many different decisions that need to be taken, and we use different kinds of technologies in each place. I hope that answers your question, Mr. Ghosh.
It does, to a large extent. Thanks.
This is the Sharadji's last query would like to take for this session. And
am I audible now or no?
Yes, ma'am.
Okay, I'm just new to it, so I'm very deep knowledge about everything. But my query is like, how do you decide on which day you're going to invest the money? Like the market was so volatile. Like on Tuesday it was 57,000, and on Wednesday it crashed down. So how do you decide on which day you're going to put the money? I don't know if my question is very relevant or not.
Basically, the volatility that you're talking about, that's I mean, it's this kind of a volatility that we've seen over the last 2 days. It's not something that we encounter every day, right? Usually the markets are more generous than that. But generally what the way we do this is, unless it's a scenario that requires, significant attention. So for example, something like now, right? But most of the time, the capital, when it comes in, it's deployed within the first couple of days, 3 days. So in many ways, the investor is making the decision of the timing when you want to invest. And what we are doing is, once you've decided that, okay, fine, I want equity exposure starting today, we are giving you the best possible equity exposure that day onward. So we don't take that call of timing, except for certain very, very extreme situations. So for example, over the last couple of days, we've had certain investors coming in and telling us, look, the markets have corrected, so now we want to add, and people have been topping up their investments, right? So that question of that decision of timing is with the investor most of the time.
Okay, like we can decide like on what day I want my investment to be done. Like that I can communicate to you.
So you can fund your account accordingly. So whenever you want the investment to be done, you wire the amount on that date, and we'll be able to deploy it as per your instruction.
Okay. Okay. Thank you so much. Thank you so much.
Thank you. Thanks, Achin. Thanks, ma'am, for addressing the investor's query.